Hello everyone, welcome to our Egyptian online seminar group. First, keep phones off. Then, if you have any questions, you can ask our speaker after her presentation. I have great pleasure of welcoming dear Professor Sandra Vera-Munoz. Sandra is an associate professor of accounting at the University of Notre Dame. She is an Ernst Young faculty fellow at Notre Dame Deloitte Center for Ethical Leadership faculty fellow. She studies how corporate sustainability disclosures affect firm valuations and investor judgment. He received a bachelor degree in accounting from the University of Puerto Rico, an MBA from Penn State University, and a Ph.D. in accounting from the University of Texas at Aston. She published in top ranking journals in accounting, such as the Accounting Review, Contemporary Accounting Research, Review of Accounting Studies, Auditing, a Journal of Practice and Theory, Accounting Horizon, Accounting Organization and Society, and the Journal of Business Ethics, among others. She served on the editorial board of Accountability in Sustainable World Quarterly. Now we will start our seminar with the Professor Sandra.
Thank you so much, Mohammed. Thank you for having me today. Thank you for your invitation, and thank you everyone for joining us today. So my co-authors on this paper are Jim Fredrickson. He's at the Melbourne Business School. Jeff Miller, he's here. He's my colleague at the University of Notre Dame, and he's on the call, so he will be taking notes. We look forward to your questions and suggestions. So let's get started. So let me show you the roadmap of my presentation here, and I want to highlight that I'm going to discuss the so-called Libby boxes, because the Libby boxes allow us to discuss our theoretical constructs as well as our operational constructs, and also map them to our theoretical hypothesis and to our operational hypothesis. So we're going to spend some time on the Libby boxes. All right. So what motivated our research question? I believe that most, if not all of you, might be aware of research, the growing demand for research, the growing demand for corporate sustainability information. And so this growing demand has in turn prompted a large body of research into how investors react to this information. And one important takeaway from this research is that it shows robust evidence that the markets actually price corporate sustainability information. And this research, by the way, is both empirical behavioral, so experiments, as well as empirical archival. So both types of methodologies demonstrate that the markets or investors price corporate sustainability information. Now, one key point here from the current state of research is that prior research examines, for the most part, prior research examines investors' aggregate reactions to sustainability information. And the implication of that is that this prior research treats investors as a homogeneous group, as a monolith, if you will. Now, we know that we learn from psychology research that there's actually variations in how people, how individuals evaluate the trade-off of activities or initiative, and how they value their outcomes in social settings. And there's some references there if you want to look at them. But in general, the point here is that how investors react to sustainability information is likely more nuanced and more complex than what we learned from prior studies that look at investors' aggregate reactions. So this leads to our research question. So what we're trying to examine here is, can we reliably explain the differences in how investors react to corporate sustainability information using a personality trait that is both identifiable and measurable? So we're going to rely on social value orientation, and which I'll be referring to it as SVO, as the title of our paper suggests. We believe that examining this research, the results of the findings from our study are important for various reasons. One reason is that we believe that treating investors as a homogeneous group, as a monolith, can potentially mask conflicting or offsetting effects based on different individual characteristics of investors. So so we might not be able to go into these effects or tease out those effects with aggregate data. Also, the ability to classify investors based on social value orientation can actually enhance our understanding of how investors respond to sustainability, to corporate sustainability information. And the differences in social value orientation could be associated with differences in how investors react to the information, which in turn could be associated with, could have different impacts on their valuation, firm valuation judgment, their investment judgments. The way that we go about addressing our research question is we use experimental methods, which allows us to do two things. One is it allows us to measure participants' SVO, social value orientation, at the individual level. And of course, it also allows us to control for any potentially confounding variables. So we control for that and reduce noise. I'm going to go over 3 experiments. So we design and conduct 3 experiments. Experiment 1 is our baseline experiment for hypothesis testing. And in the setting in experiment 1 is that the company starts a sustainability initiative. In experiment 2, we're testing, well, if our theory, we're testing the robustness of SVO theory. In other words, if our theory is correct, then we should be able to find results that are consistent between the 2 experiments. Experiment 3, we are testing the boundary conditions of SVO theory. And what that means is that instead of having a social context, instead of having a social context, we have a general business context. So the company is starting a non-sustainability initiative. So we don't expect to see results, to see SVO playing a role in the 3rd experiment because it is not a social context. So there is a huge body of research on SVO, and I'm gonna try to do my best to summarize it here in at least the key findings from SVO research in a nutshell. So the beauty of SVO is that it reflects individual preferences for the distribution of outcomes between what we call self and others, so the other person in social settings. There's a common categorization of SVO as pro-self or pro-socials. And pro-selves, according to this theory, are someone who is classified as a pro-self is someone who prefers to maximize their individual outcomes. So they care more about their own welfare than about the welfare of others. The pro-socials, people who are characterized as pro-socials, they prefer to maximize joint and equal outcomes. So they care about their welfare, but they also care about the welfare of others. The advantage of this category, of using this categorization, is that this pro-self versus pro-social construct has been well validated in prior research, and in many different settings. And you're looking at some of the settings, not the only ones, but negotiation, tax, economic gains. I can see this being used in social political context, for example. One important observation here is that SVO is generally stable over time, but it is not immutable. So what that means is that there could be some situational factors that may cause people to switch, that may cause switches shift in how individuals evaluate or prioritize their own welfare versus the welfare of others. But for this particular study, we assume that SBO is a stable personality trait. All right, so these are the Levy boxes. I'm from Robert Levy. So the top half of this figure shows our theoretical constructs. The bottom half of our figure shows our operational constructs. Our independent variable is social value orientation. That's the conceptual theoretical construct is social value, independent variable is social value orientation. Our theoretical dependent variable is investors' judgments. We're also going to be looking at mediating roles of two theoretical constructs, the investors' affective reactions, as well as their assessments of their expectations of future earnings. So moving to the bottom half of the figure, the way that we operationalize SVO is by using those categories that I mentioned earlier, pro-self versus pro-social. And obviously, this is set by nature, so this variable is not manipulated. It is set by nature. Our dependent variable, operational dependent variable for investors' judgments is in the investors' willingness to invest in a firm's stock. To operationalize affective reactions, we use a latent variable that is called affect. And this variable of affect, we borrow from research by Elliott, Jackson, Fisher, and White in a paper that they published in the Accounting Review in 2014. So this is a latent variable that we construct in a similar way to what Elliott et al. Did using factor analysis. And then for the future earnings expectations, we assess participants' assessments of their expectations about the stock price growth. And then, of course, as I mentioned earlier, the beauty of experiments is it allows us to control for everything else, so that to rule out any alternative explanations for our results. So we make sure to that information is held constant across all participants, and we also have some screening criteria for the eligibility of people to participate in the experiment. And as I will mention soon, we use Prolific to help us with the screening. All right, so I'm going to start building our model, but we're going to start with, notice the title of this slide is baseline prediction, and these are baseline. We use experiment 1 as our baseline predictions. These are theoretical constructs, and then when I move to the methodology, then you'll see that I'll show this model again in the context of structural equation modeling. So to show you guys how this plays out. So the language in the theoretical hypothesis. So hypothesis 1, we are looking at the association between SVO and affect. And H1 predicts that in response to a firm's sustainability initiative, prosocial's affective reactions are more reflective of the social effects of the initiative, whereas the pro-self's affective reactions are more reflective of the firm level financial effects of the initiative. Hypothesis 2 looks at the association between affect and willingness to invest. So H2 predicts that investors' willingness to invest is positively related to their affective reactions to information about a company's sustainability initiative. So in other words, what we're saying here is that if investors have a favorable affective reaction to the company's sustainability initiative, then that should be associated with a higher likelihood of the pro-social investors investing in the willingness to invest in the company. And of course, the opposite would be true for pro-self pro-self investors. We also have a research question, and notice that the research question is the association between social value orientation and the investors' expectations of future stock price growth. So you might be wondering why is this a research question as opposed to another hypothesis? So the reason for this is that it could go the direction could really go either way. So there's reason for predicting positive versus negative association. So we could have a non-directional hypothesis, but the truth is that this relationship here is more exploratory. But here's the rationale that we're thinking with respect to this research question. So the pro-socials could argue that that because any social initiative is costly and it is net costly, and in our case, by the way, the social initiative is net costly, right? So they might not be so pro-socials might not be convinced of the business case for sustainability, and so they could believe that the initiative could actually be detrimental to stock price growth. So if that is the case, then pro-socials might behave similar to pro-self investors. So for that reason, it's a research question. We don't really have, we're really exploring that association. Having said that, we have hypothesis 3, which looks at the association between affect and stock price growth. So hypothesis 3 predicts that investors' stock price growth expectations are positively related to their affective reactions to information about a company's sustainability initiative. So what we mean by that is that if investors have a favorable affective reaction to the company's sustainability initiative, then they might have a more favorable assessment of, or a more optimistic assessment of the growth of the firm stock in the future. Hypothesis 4 looks at the association between stock price growth expectations and willingness to invest, and it predicts that investors' willingness to invest is positively associated to their stock price growth expectations. So if in other words, if investors feel optimistic that the company's stock price is going to increase, if the company's stock is going to grow, then they might be more willing to invest in the company. Last but not least, we have hypothesis 5. And notice that hypothesis 5 predicts a direct association or direct effect between SVO and willingness to invest. So this hypothesis is last but not least because we're predicting a direct effect even after controlling for the mediating roles of affect and stock price growth expectations. So we're saying that SVO, investors are going to have it reflects the internal preferences that pro-self and pro-social have for willingness to invest above and beyond their affect, the mediating role of affect, and the mediating role, if there is any mediating role, of stock price growth expectation. All right, so now that we have gone over the, what are we doing in this paper and what are we predicting, and I'm gonna move on to the methodology. So these are our experimental tasks and procedures, and this is a very busy slide, but I just want to call your attention to the fact that we have pre-experimental attention check questions, we have post-experimental attention check questions. We screen participants based on the responses. Participants who fail 2 key attention check questions, we screen them out. We drop them out of the sample because if they're not paying attention to key information, then it's not it's not good to keep them in the sample. We collect in steps 3 and 4. We collect data to help us measure our dependent variables. We also have some process questions, and the process questions are in steps 5 and 6. And what that means is that we ask participant questions to see how they were how they were thinking, what were their beliefs when they were answering these questions, and this allows us to go in the so-called black box. So I will discuss these questions with you guys. And then we collect our dependent variable, which is social value orientation, until after, almost at the end of the experiment. The reason for that is because we don't want to pre-bias our participants if we ask these questions ahead of the experiment. So we collect that information. We collect the data in step 7, and then step 8 is just demographic stuff. And by the way, we use the same experimental tasks and procedures across our 3 experiments. So everything is the same across the 3 experiments. All right, so as I mentioned earlier, we use Prolific, which is a company that specializes in providing participants for academic experimental research. And our eligibility requirements is, one beauty of using Prolific is that it doesn't allow for repeat participants. In other words, we didn't want participants, we didn't want people participating in more than one experiment, right? Because that would add noise to the data. They have to be fluent in English, so US or Canadian residents, at least 18 years old. And they have to have a minimum education level of an undergraduate college degree. The financial knowledge is very basic for this experiment. So, even people without accounting training are able to do this experiment. Across the 3 experiments, it took about 10 minutes to complete the experiment, and we paid a fixed fee of $3 to participants, which translates to about $18 per hour, not including benefits. All right, so here's excerpts of the instrument for experiment 1. And so several important remarks here for some key issues, key facts in the design of this instrument. So the first thing is, so here's the third paragraph that you see in the red boxes is what we told the participants. There's a new CEO that started in 2022, and the CEO started a new policy that that each year the company was going to donate 10% of before tax profits to charities in third world countries. Now, we also, very importantly, we also provided abbreviated financial information, and the rows that you see in the red boxes are critical here. First thing is we provided data on profit or net income, and we provided data on the charitable contributions. So the charitable contributions, as you see here, they start in 2022. So notice that the year that the donations start, profits drop. So this is a key feature of our design, because we wanted to make sure that the participants saw the direct effect of the donations on the firm profit, right? And so this is a key design, because we didn't want the participants to imagine, if we didn't provide them with this financial information, then we would have left it up to them to imagine, okay, what could have been the financial consequence of this donation? So we don't leave that to the participants' imaginations. And in fact, we provide them with the data, say, look, profits dropped the year that the donation started. And this is also important because so to make sure that the participants pay attention to the data, we told them from the beginning, we're going to ask you some questions about this narrative. And so, read this carefully. And so our attention check, one of our attention check questions, pre-experimental and post-experimental, is what happened to profits the year that the donation start? And then they had to indicate that the profits decreased the years that the donation started in experiment 1, at least in experiment 1, okay? So, and of course, again, as I mentioned, the participants who fail those attention checks, we drop them from our sample. we have in our paper an appendix where we explain how we construct our independent and dependent variables. I want to focus on our independent variable for social value orientation. So we use based on prior research, and I put some references there. We use the so-called 9 questions decomposed games measure. That's a mouthful. What that means is that this consists of 9 questions, and that the participants have to respond. And in each question, the participants have 3 options. One of the options is the so-called prosocial option, and in this case, so hold on, I'm jumping ahead of myself. In each question, the participant needs to select one of 3 options for how the points will be distributed between themselves and an anonymous other person. Okay, so this example here, option C, is represents the prosocial option, because notice that they're the same number of points for self and the same number of points for the other person. Options A and B represent the pro-self options, because notice that there are more points for self than for the other person. So based on prior research, the way that we classify people as pro-self versus pro-social is by looking at the responses to each of these 9 questions, and we classify participants who selected the pro-social or pro-self option for at least 6 out of the 9 questions. So if they selected 6 or more pro-social options, we classify them as pro-social. If they selected 6 or more pro-self options, we classify them as pro-self. If participants select less than 6 of either the pro-self or the pro-social option, then we drop them from the analysis, because then that means that they cannot be classified. For affect, I mentioned that we use affect is a latent variable that we construct from using factor analysis, and we borrow from the Elliott et al. Paper in the accounting review in 2014. So stock price growth expectations is a scale, and here we just simply ask them based on the information provided, indicate the extent to which you believe the market price of the company's stock will decline or increase over the next 5 years. So we're not asking them to give a price, but simply indicate whether the stock price will significantly increase or decrease or not change over the next 5 years. And then willingness to invest is similar to prior research. It's what is your willingness to invest in this company stock, having seen what you saw. So these are the questions that the attention check questions. Did profit or net income increase or decrease from 21 to 22? And then that's pre-experimental, and post-experimental select the one option that best describes the change made by the company beginning in 2022. So the star indicates the correct answer there. And if any participants who fail either or both of those questions were dropped from the analysis. All right, so let's start with the univariate statistics, univariate test. So these are our main dependent variables. So we have affect, stock price, and growth expectation and willingness to invest for experiment 1. Notice that for affect, so the important thing to look at this means is the signs of these means. For prosocial, the sign is positive. For pro-self, the sign is negative. So what that means is that the prosocial participants, they had more favorable affective reactions to the sustainability initiative, the charitable donations, while the pro-self participant had an unfavorable affective reaction to the information about the donation. Those means are statistically different. I should mention again that affect are the means of the score from factor analysis using maximum likelihood And this factor for experiment 1 explains a very high percentage of the variance in the response, almost 86%. Notice that stock price growth expectation, the means between pro-self and pro-socials are not significantly different. However, for willingness to invest, notice that as we expected, the pro-socials indicated a higher willingness to, significantly higher willingness to invest than did the pro-self. All right, so I mentioned earlier that I showed the theoretical hypothesis, and I think now we can move on to the operational hypothesis and testing all of these regressions. So we're using structural equation modeling with a latent variable and bootstrapping to test our relationships simultaneously. So that's why we use SEM. One important observation here is that now for the first time, I'm sharing how do we code SBO, and so we code pro-self as 1 and pro-socials as 2. So for H1, notice that it shows a positive coefficient here. So the association between social SBO and affect. So we expect pro-socials to have a more favorable affective reactions to the information about the charitable contributions relative to pro-self. So the coding here matters, and of course we have positive coefficients for the other hypothesis, which only makes sense. All right, so here are the results from the structural equation modeling. As expected, so we do 2 things here. We run the SEM. We show the simultaneous. These are the simultaneous effects of all of these factors, and but I'm also going to show mediation effects too. But starting with our hypothesis here, H1 as expected, the coefficient is positive and it is highly significant. So that provides support, empirical support for our first hypothesis that pro-social investors' affective reactions were more favorable than relative to the pro-self investors. For H2, the coefficient is, and these are standardized coefficients, I should mention. For H2, the coefficient is also positive and it is highly significant. So favorable affective reactions are associated with higher willingness to invest in the firm stock. For RQ1, notice that the relationship between SBO and stock price is not significant, and so that is not surprising. As I mentioned earlier, the pro-social investors might consider, well, this is a net costly initiative, so it's not clear that the business, how the business case for sustainability could be justified, and it could so absent affect effects, right? So they say that the business case for sustainability might, given a net costly initiative, cannot be completely justified, and so it might not actually improve stock price in the future. For hypothesis 3, the coefficient is positive and highly significant as expected. So favorable affective reactions are significantly associated with belief that higher assessments of stock price growth in the future. For H4, willingness to invest, so the coefficient is positive and highly significant, and willingness to invest. So there's positive association between stock price growth and willingness to invest. So the higher my assessment that the stock is going to grow in the next 5 years, the higher is the willingness to invest. Last but not least, we have the direct effect between SBO and willingness to invest. And notice that the coefficient is positive and is also significant. So this means that even after controlling for the mediating role of affect and mediating role of stock price, there's still a direct effect between SVO and willingness to invest. So this shows intrinsically how the SVO works, the strength of the robustness of SVO. This is inherent in investors, in how the investors reacted to this information after controlling for everything else. So as I mentioned, we also run mediation effect tests. So these are structural paths that what you see here in panel A at the bottom of this slide. So we look at so these results. The first mediation is the mediation role of affect, and the results simply indicate that affect does indeed play a mediating role between SVO and willingness to invest. However, stock price growth expectation does not play a significant role between SVO and willingness to invest. We also examine a third path from SVO to affect, from affect to stock price growth, and from stock price growth to willingness to invest, and that path is positive and highly significant. Overall, combining the total indirect effects with the direct effect, we get significant results. All right, so I mentioned that in addition to looking at these associations, we also want to look at process questions, so the mechanisms behind these associations. So we have these experimental questions. So we asked the participants, we wanted to find, these are questions that speak to the business case for sustainability, right? So we asked them, as a result of the company's decision to donate, to do these charitable donations, how do you think this is going to affect, customers, sales, employees, litigation and regulation risk, and the company's overall performance? And we use a scale from 0 to 100. So these are the means and standard deviation of these stats for the mean responses of pro-self versus pro-social participants. And notice that for 4 out of the 5 items here, the results are significantly different between pro-self and pro-social. So pro-social had a more optimistic reaction to how the donation will affect these items relative to pro-self. When we aggregate the means across the 5 items, the difference in means are also significantly different. So this provides, this helps us understand better, how the pro-self versus pro-social participants were thinking when they were evaluating how will this affect, this company going forward. All right, so before moving to experiments 2 and 3, let me briefly summarize the key results from experiment 1. So what the takeaway from experiment 1 is that pro-social reacted more favorable than did pro-self to the information about the charitable contributions, and the pro-social favorable affective reactions are consistent with a preference for the social initiative, even when these donations were financially costly to the firm. And we made it very, we make that this association between the donation and profit very clear in the financial information. So even after seeing profits drop, but they still reacted, the pro-social still reacted favorably to the information, whereas pro-self have the opposite reaction. They have unfavorable reactions that are consistent with a focus on the financial cost of the social initiative rather than on the benefits to society from this initiative. We also, experiment 1 also provides evidence supporting the mediating role of affect between SVO and willingness to invest, and also a direct effect between SVO and willingness to invest, even after controlling for the mediating effects of role of affect, which is consistent with the pro-social having a social utility type preference for social initiatives. So that's our we believe is are the main effects from these main takeaways from this experiment. All right, so the beauty of these experiments is that there's always something more that you want to learn about. And so experiment 2 is really testing the robustness of the theory. So if our SBO theory is correct, then we should expect to observe SBO consistent results in a counterfactual context. So this counterfactual context, instead of starting the sustainability initiative, the company is actually stopping a sustainability initiative. So this is what we the narrative. These are excerpts from experiment 2. So the new CEO, so the company hired a new CEO in 2022. This new CEO, but that the company's primary responsibility is to its shareholders. So this is the principle of shareholder primacy, so to speak. And so consistent with this, starting in 2022, the CEO has decided to discontinue the donations. So notice now that the 3 years prior to 2022, so there were donations, right? Here are the profits. And then in 2022, notice that the donation stopped and then profits went up. Okay, so that was important. And again, we asked the participants attention check question that what happened to profits? Did they go up or down? In this case, the correct answer obviously is they went up. And so that if they said otherwise, then they were dropped from the analysis. So these are the univariate tests. Yeah, so means for main dependent variables. So notice now for the prosocials, looking at affect, the sign of this score is negative for prosocial. Remember, for experiment 1, the sign was positive. Now it's negative. Whereas for proself, the sign is positive. Remember, in experiment 1, the sign was negative. And the difference between these two means is significant. For stock price growth expectations, not differences between proself and prosocial. So they behave, prosocial and proself behave the same when it comes to stock price growth expectation. This is just looking at this particular variable, not relationship with anything. And then willingness to invest. Notice that now the proself means are higher, significantly higher than the prosocial means. So the proself were significantly more willingness to invest on average in the company after stopping the decisions to stop the donations relative to the prosocial. The prosocial were actually less willing to invest. All right, so here's the model again, and notice that we now expect, remembering that proself are coded as 1 and prosocial is coded as 0. So now this is what we call the operational hypothesis, right? That we expect a negative coefficient for the association between SBO and affect in this experiment. And similarly, we expect a negative coefficient for the association between SBO and willingness to invest. The rest of the model is the hypotheses are, the signs are the same as for experiment 1. So here is the model, the result of our SCN model using bootstrapping with 1,000 samples. So notice that I'm not calling attention with the red arrows to the key results here. So H1, the coefficient is negative and is significant. So that means that the prosocials had a more unfavorable. Sorry, the prosocial had a more unfavorable affective reaction to the company stopping the initiative relative to the proself. And the direct effect between SBO and willingness to invest, as expected, as predicted, the coefficient is negative and is also significant. So what that means is that the proself willingness to invest was significantly higher. They were more willing to invest than after the company decided to stop the charitable contributions relative to the prosocials. The other hypothesis, the coefficients are as expected and significant, except for the association between affect and stock price growth, which did not load up. So that was an interesting result. We're still intrigued by it. But then we go into the mediation effect test. So the mediation effect test, the first one provides evidence that affect does indeed play a significant mediating role between SBO and willingness to invest. The second mediating effect test, so looking at the mediating role of stock price growth expectation, that is not significant. And then neither is the third mediation effect of looking to SBO, affect, stock price, and willingness to invest. The sum of the total indirect effects plus the direct effects of that whole structural path is significant. All right, so looking at our process, the mechanism. So we're looking at you know, the question about the real effects, right? The business case for sustainability. Notice that for 3 out of the 5 items, there are significant differences between pro-self and pro-social, but overall the means tend to be higher for pro-self than they are for pro-social, as expected. So the pro-self felt more optimistic about, or yeah, more optimistic, more favorable about how the donation was going to affect these items for the company. When we aggregate the items, the overall means are significantly different, higher for pro-self than they are for pro-social. So the key results for experiment 2. So in general, it shows it provides evidence of the robustness of SBO theory. In this case, when the company stopped the sustainability in the charitable donation, the pro-social, as expected, reacted more unfavorably than did the pro-self. The pro-social's unfavorable affective reactions are consistent with a focus on the social cost to society of stopping the social initiative. The pro-self favorable reactions are consistent with a focus on the financial benefits of stopping the social initiative rather than on the cost to society. And then the results of the mediating test are similar to our results from experiment 1. All right, so of course we wonder, okay, so we have starting, we have stopping, so experiment 1 starting the donations, experiment 2 stopping the donations, and then we have SBO. So of course it makes sense to examine, and so this is an additional test that we run. So our main focus is on looking at this simultaneous effects of all these variables. So looking at all these variables, the associations simultaneously, and that's why we run the SEM. However, it's also worth looking into, is there an interaction between starting and stopping and pro-self versus pro-social? And the answer is yes, and the answer is yes for, excuse me, for when we look at affect, and in the next slide, when we look at willingness to invest. So the dotted black line represents the pro-self. Notice that their effect in the starting, when the company starts the sustainability initiative, their affective reactions are unfavorable. When the company stops the initiative, as we saw, their affective reactions are actually positive. For pro-social, is the opposite. When the company starts the initiative, their affective reactions are favorable. When they stop, the company stops the initiative, pro-social affective reactions are unfavorable. And so these are the means. These are the same ones that I showed you earlier. And it just shows that the difference between here and here are significant. The difference between here and here are also statistically significant. And so we did the same thing. We look at the interaction also for our dependent variable, the willingness to invest. And we see evidence of an interaction. So higher willingness to invest for pro-socials when they start the initiative. When the company starts the initiative, lower willingness to invest. When the company stops the initiative, for pro-self, it's the opposite. Lower willingness to invest when starting the initiative, higher willingness to invest when stopping the initiatives. And here are the tests of differences in means between the 2 points in the lines. We also run a regression model, so not a simple regression model, and the regression model supports the interaction between SBO and willingness to invest, and is highly significant. So this is additional tests that we run. All right, so moving on to experiment 3 with the non-sustainability initiative. So here we're testing the boundary conditions because social value orientation is more, we claim that it should be manifested in social context, but not necessarily in non-social context. So we call this a non-sustainability context, which is more like a general business context. So the narrative here is that the company hired a new CEO, and this new CEO believes that companies should be at the forefront of supply chain management technologies to optimize inventory tracking. So the CEO decides that starting in 2022, they're going to start a new policy of investing 10% of before tax profits in this new technology. That's pretty much the story. Notice that the financial information is exactly the same that we provided in experiment 1 with starting the initiative. The numbers are exactly the same. Okay, so we left everything is held constant except for that now it's a non-sustainability initiative. So these are the means. Here are the means of the univariate test, means and univariate test for our main dependent variables. So we see that the negative coefficient for affect for prosocials and positive for proself. However, and these are two-tailed tests because we expect no effects of social value orientation on, or no association between social value orientation and affect. So these means are not significantly different at the two-tailed test. Stock price growth expectation, notice that the means are very close to each other, so not surprising the p-value is so high. Willingness to invest, the numbers are close to each other. Proself was a little bit higher than prosocial, but these means are not significantly different. So for operational hypothesis, remembering that proself are coded 1 and prosocial are coded 2, we expect, so NS stands for non-significant, so we expect no association between SBO and affect, and no association between SBO and willingness to invest, and this is why we have the NS here. All right, so here are our results. So these are H1. The coefficient is negative, but at the two-tail level, it is 0.109, so 0.11. So at the two-tail level is not, the association is not significant. For our hypothesis 5, the direct effect between SBO and WTI also is negative. The coefficient is negative, but notice that it's not significant. And then here's H3. We get significant result for H3. So this is similar to the result for experiment 1. And we also get, and the coefficients are in the right direction. They're all positive for H3, H2, H3, and H4. They're all highly significant, as would be expected. The mediation effect test show that affect does play a significant mediating role between SBO and willingness to invest. Stock price growth expectation still does not play any mediating role. So this path, this indirect path, never loads up in any of our experiments. And then the third path from SBO to affect to stock price to willingness to invest is significant in this case. But notice that the total model combining the indirect effects and the direct effect is not significant. This model, when we look at the goodness of fit statistics, so the good enough fit statistics suggest that this model, the fit is 4, and it's not surprising because SBO really is not playing any significant role here, whereas the good enough fit test in the 2 previous models, they're adequate and they're adequate and acceptable. Looking at the post-experimental questions, so looking at the process questions. So this is, I think these are important results. So remember, we're asking participants, how do you believe that the initiative is going to affect these items? So this is the case for sustainability, right? So notice that the means for the prosocials and for the proself for each one of these questions are very close to each other, right? So this provides, process evidence that supporting the fact that SBO really, in this non-sustainability context, really did not play a significant role in the the participants' affective reactions or their willingness to, the direct effect between SBO and willingness to invest. Notice that they behave, the prosocial versus proself behaved similarly in how they, in terms of how they felt this general business initiative was going to affect these items. When we aggregate the means, of course, among the 5 items, as expected, the means are not significantly different. So to summarize the key results for experiment 3, unlike the result from the previous 2 experiments, investors' reactions to starting the non-sustainability initiative were not different between proself and prosocials, and also the affective reactions were not significantly different between proself and prosocial investors. The mediator effects, the test of the mediating role of affect is still significant. So affect is still playing a significant role, but we don't see evidence of an effect between SBO and willingness to invest, and we don't see any evidence that of the role of stock price growth expectation mediating the association between SBO and willingness to invest. All right, so to conclude, excuse me, we believe that our study provides evidence that SBO provides a reliable and measurable and theory-driven way of categorizing, classifying participants based on their SBO at the individual level. And so it provides evidence of that the individual investors, how they react to information when we compare from the aggregate reactions versus the reactions that take into account these individual differences. So our results suggest that these reactions are more nuanced and more complex and than we see at face value, and that this allows us to, our experiments allow us to tease out these differences in counterfactual settings and also in different contexts where we don't expect SBO to play a role. We also show that proself and prosocial investors respond very differently to information about the CSR initiative. So when in the starting experiment 1, the prosocial reacted more favorably than did proself, whereas in the stopping experiment, proself reacted more favorable than did prosocials. We believe that these are some of the ways in which our study contributes to prior research. One is that even when we hold constant the valence of sustainability information, so in this case, remember that we told the participants the company is initiating this donation. This is costly to the firm. So this was constant across experiment 1 and 2. So even when the variance is held constant, investors' affective reactions to information vary depending on whether they are pro-self versus pro-social. So this is, again, when we speak to how nuanced, when we look at the individual level, not the aggregate level, there's more nuance to given individual differences between pro-self and pro-socials. We also show evidence using experiments that there is a direct relation between SBO and willingness to invest, even after controlling for the mediating effects of affect and stock price. We also provide evidence of the robustness of SBO theory and also evidence of an interaction between SBO and starting versus stopping a sustainability initiative. And then we also provide evidence of the boundary conditions of SBO in the sense that SBO was play a role in a sustainability social context, but not in a non-sustainability context. Our results also point to some direction for future research. For example, it would be interesting to examine other sustainability settings, for example, environmental or green initiative, or even look at social political context. That would also be interesting. Secondly, our investors in our study, they play the role of potential investors. It would be interesting to examine, the generalizability of our findings if investors play an active role. Our investors we assume that they are non-professional investors. It would be interesting to also look at how investors are professional investors, and it's debatable whether investors in general are impounding ESG data into their firm valuation judgments. So it would be interesting to look into that. Also, in our study, as I mentioned, it was extremely critical to provide the financial effect of the initiative on profits. We realized that in reality, companies do not always disclose how the financial effect of this initiative. They don't disclose them publicly. So it would be interesting to see to examine when the difference between providing versus not providing the financial effects of the CSR initiative. And there are a few studies that look into that, and but we need more research. We need more research on that. So with that, I want to thank you for your time. And these are our email addresses, Jim, Jeff, and mine. And we look forward to your questions and comments. Thank you.
Thank you very much, dear Professor Sandra, for your contribution and your effort. It's really an excellent presentation and excellent paper. Now, if anyone have any questions, you can open your mic and ask your question. Yes, if anyone have any questions, you can open your mic and ask your question. Yeah, Dr. Hugo. If anyone have any questions, you can open your mic. Yes, you can.
Hello.
Yeah, you can ask.
Can you hear me?
Yes, of course.
Yes, Hugo. Hi, Hugo.
Hi, because it wasn't allowing me to unmute, and I put something in the chat. Thank you. It's Masood from the UK, from the University of Huddersfield in West Yorkshire. I was going to mention 2 points, but then when I looked at the last slide, I was glad that you mentioned the environmental, because
yes.
yeah, the first thing that was going through my mind, I said, how did they define sustainability, and did they share that definition with the target participants? because all along I felt that you were only focusing on the social side, and I just wondered whether if the environmental element of sustainability was included, maybe your results would have been maybe different. The pro-self and the pro-social, I think, because these things are obviously interrelated. But I'll probably leave that aside, because I thought I should maybe focus on something else. When I looked at the data timeline, I think it finished in I think your last year is 2023, right?
Yeah. Let me put it back in the oh, that's not it. Hold on. Oh gosh.
No, it's fine. It's fine. I feel like my point is about something which I consider to be, I believe, quite relevant. Particularly with regard to, I think, experiment 1. I felt that maybe there's an assumption there that investors believe companies' sustainability information. However, there are plenty of studies that say otherwise. They say companies release information about their sustainability, CSR, the corporate, social the sustainability reports.
Yes.
But not all investors have confidence in them. They say probably around less than a third of investors have faith in those reports. And that then takes me to the reason why I mentioned the timeline, because if when you did your data collection, you were talking up to 2023 or maybe towards the end, by the end of 2023. Now, that for me is a very important thing for at least for the future of this work, because 2023 was when they introduced the I believe the corporate sustainability corporate social responsibility reporting directive.
Yes.
And then more than that, and this is related to my point about whether investors have faith or don't have faith in the reports, is that now they have mandated, they have made it compulsory, particularly on listed, large listed companies, to not just release information or disclose information, but they have to have it audited. So I think as of January 2024, I think it became compulsory on large listed companies to make sure that the information is given the seal of approval, if you like, by auditors. And I just wanted what your views are on this, and to what extent, for like, in terms of the advice you would like to give to future researchers, because in a real life setting, obviously, my feeling, I may be wrong, but investors probably now they are going to have probably more faith in those reports because they are now audited. Okay?
Yeah.
And maybe that will, if you like, be enough incentive for investors, whether they're individual investors like the ones you have in your data set, whether they're like institutional investors. I think they will have more faith in the sustainability reports, and maybe the pattern of investment and the size of the investments, I believe, will be different. Sorry if I spoke too much, but I wanted to.
No, that's fine. I do appreciate your comments. These are you raise really good points. So there's two parts to this to your question. One is the context, right? That we look at social context. What about other contexts? And we completely agree with that point that our starting point was a social context. Full disclosure, we have also tested the environmental context, but we're still working on it. And so, yes, this could be tested. Environmental context actually provides a very rich context, no question about it. And it allows for all sorts of other things that we can look at Now, your point about auditing the credibility or reliability information, I could not agree more with you. Of course, I mean, in the real world, you would expect the users of these reports to lend more credence, to feel more comfortable with information that is audited versus not, right? And I do believe that there's already research that speaks to that. In fact, I think at the 2022 Accounting Organization Society Conference, I actually discussed the paper by Eddie Cardinals and his team that where they look at that. They look at whether the reports were audited or not. So we're fully aware of that manipulation. And I do believe that we continue, it is important to continue doing research that looks into the credibility of information given, particularly because of all the regulations in Europe as well as in the United States that mandate, at least for the time being, limited assurance, but eventually phasing into reasonable assurance. So these are excellent points. And now, why we didn't look into auditing for this experiment, but because we were laser focused on this is, you know, the so-called first pass through the potato field. So we're laser focused on SBO, right? And we wanted to build a model that will look at these associations that we believe that, given prior research, it would be important for us to test simultaneously to be able to understand, you know, how pro-self versus pro-socials react to this information. But I do agree with you that, you know, future research should look at different contexts, as well as, you know, add the you know, audited versus not audited. And in fact, I will take that a step further, you know, eventually limited assurance versus reasonable assurance. So yeah, that I agree. It is a good point, but for this study, we wanted to focus on this and then leave everything, focus on these variables and then leave everything else constant. But it does provide, you're exactly right, that the richness of corporate sustainability information lends itself to looking into auditing, you know, audited versus not, limited versus reasonable assurance. And I actually have a paper with other co-authors that look into limited and reasonable assurance for sustainability information. And that paper actually shows that people actually have a very hard time understanding the difference between limited and reasonable assurance just looking at auditor effort. So we have some preliminary evidence of that. It's another experiment with a different research team, but we do have evidence that people struggle understanding the difference between limited and reasonable assurance in sustainability context. Thank you for your question.
And thank you for the answer. Thank you.
Yes, if there another question, if anyone have any question, you can open your mic and ask your question. If anyone have any questions, you can open your mic and ask your question. Yes. Hugo, you have a question? If anyone have any questions, you can open your mic and ask your question. Thank you very much, dear Professor Sandra Vera, for your contribution and your effort. It's really an excellent presentation, excellent paper. Thank you very much, everyone joining us today, and thank you very much, dear Professor Sandra, for taking the time out to present it to us today. It's been really appreciated. Thank you very much.
Thank you so much for having me in your seminar. Thanks again for your leadership in putting these seminars together. This is invaluable to scholars, doctoral students, junior faculty, senior faculty. So thank you for the opportunity to share our findings with us. And again, if you guys have any questions, please feel free to reach out to Jim, Jeff, or myself. So
Thank you.
Thanks again.
Thank you very much. And I hope to see you in Egypt. You are very, very welcome to Egypt.
Oh, thank you. I would love to visit Egypt for sure. And I will let you know when that happens. Thank you so
Yeah,
much.
you are very welcome. Yeah.
Thank you. You take care.